Good morning to those of you joining us from the Americas, and good afternoon to those of you from the EMEA region. My name is Mark Leitner, and I'm Head of Legal Strategy here at Credit Sites, and I have the privilege of hosting today's webinar entitled U.S. Special Situations Outlook, LMEs, Litigation, and Bankruptcy. Every December, Credit Sites, along with our sister companies Covenant Review and LevFin Insights, publishes a Special Situations Outlook plus a comprehensive recap of special situations ongoings from the prior year. It's consistently one of our most popular reports across all of our platforms. For example, this past December, we published our 2026 Outlook and 2025 Review, which covered our strategy and sector outlooks, spotlight credits, a recap of all liability management transactions or exercises, often referred to as LMEs for 2025, notable litigation impacting the credit markets, and a recap of bankruptcy activity and important bankruptcy statistics. By popular demand, today's webinar is our mid-year update to that effort, and it's largely in the same format and structure as our annual outlook. Let's take a look at today's agenda. First, we're going to get a market outlook. We're going to look at defaults, distress, and the technicals driving stressed and distressed opportunities. Second, we're going to look at special situations themes. This includes sector and issuer-specific catalysts, the credits we're watching most closely. Then we're going to look at liability management and documentation. We're going to look at 2026 LME year-to-date, as well as covenant documentation developments. Finally, we're going to look at a few legal and restructuring developments, notable litigation impacting the credit markets, plus bankruptcy highlights and key cases and statistics. The goal today is to give our viewers a broad overview and update across all things special situations. To be sure, each of these topics, and really each subtopic, could be its own webinar, so we've necessarily curated the topics down to what we consider are the most interesting. Let me take a second to introduce our panelists. To my right on the virtual screen is Winnie Caesar. Winnie is our Global Head of Strategy here at Credit Sites, and she's going to be leading the market outlook. Next to Winnie, we have Jory Eisenberg. He's Head of U.S. Special Situations here at Credit Sites, and he's going to take us through sector themes and issuer-specific catalysts. Next to Jory is Ian Fang. Ian is a Senior Covenant Analyst at Covenant Review, and he's a well-known LME expert. For those of you that don't know what Covenant Review is, it's the market-leading expert on bond and loan covenants, and it's a Fitch Solutions company that sits underneath the Credit Sites umbrella. Last but certainly not least, we have Patrick Holohan. Patrick is the managing editor of our bankruptcy product at LevFin Insights, which is also a sister company of Credit Sites. Pat is going to cover the bankruptcy landscape and key case developments, and I'll be handling part of the litigation portion of our legal and restructuring discussion. Before we dive in, I'd just like to touch on a few short housekeeping items. First, today's webinar will serve as this week's episode of the Credit Sites podcast, No More Risk Better, which will be available tomorrow wherever you choose to listen to your podcasts. It will also be available for replay on our website or on our YouTube channel. You can also subscribe to our YouTube channel free of charge, and you can access a ton of great content across all our platforms. Also, many of you probably know this, but Gemini is fully integrated into YouTube, and you can interact with it and summarize it, ask questions, get a transcript, or jump to specific topics that we talk about today. Second, all of our LinkedIn bios for the panelists are in the webinar window. Feel free to connect, follow, or reach out to any one of us. In addition, within the webinar console, you'll find related content that you can download free of charge. Third, feel free to submit questions right here into the platform. As you can expect, we have a very, very large audience today, so we may not get to your questions, but if we do not get to your questions, we will follow up with you offline later today or tomorrow. And finally, we will make the slides available upon request. Please reach out through this platform, directly to any one of us, or via the events team email on the registration page, which is events@creditsites.com. Okay, let's get right into it. So we're going to look at market outlooks. So to kick us off, let me bring in Winnie Caesar to give us our market outlook, including the mid-year picture for U.S. leveraged finance, where defaults and distress stand, and how macro and technical factors are shaping opportunities. Winnie?
All right. Thank you, Mark. Good morning or evening or afternoon to everyone joining. As Mark mentioned, I run the global strategy team at Credit Sites, and we are really tasked with marrying the macro up with the micro. When I started as a strategist, I started in leveraged finance, and there was oftentimes this view that the special situations or much of LevFin operated in its own silo. And we've seen a big change in that dynamic as the macro environment, especially this year, has become increasingly important to the lower rated cohorts of both the public and private markets. We've seen a pretty major step up in borrowing costs for highly leveraged capital structures, and that's intersected with operational headwinds in key sectors and some idiosyncratic factors, of course. Heading into 2026, market participants anticipated some relief for stressed and distressed companies in the form of lower borrowing costs. The Fed had eased rates another 3 times in 2025. We saw robust inflows into the high yield, broadly syndicated loan, and of course, private credit markets. And that created very competitive underwriting conditions and strong primary markets. New issue spreads and yields were driven to tighter levels, and there was a big revival of optimism around that much needed sponsor to sponsor M&A cycle for some of the special situations cohort. What many, including us, did not necessarily have on our bingo card for this year was the intersection of AI-fueled software concerns that really started to percolate at the end of 2025, combined with the onset of the US-Iran war, which materially repriced inflation expectations higher and monetary policy expectations tighter as well. In fact, this morning, the ECB raised rates in response to the fuel shock that we are seeing globally. And it would not be particularly surprising to the market, at least, for the Fed to follow suit at some point over the course of the year. These events converged in the first few months of the year to really amplify BDC concerns as the narrative has shifted to concern around credit quality, hefty redemptions, and portfolio valuations across these less liquid loans. Now, interestingly, just as we observed a significant divergence in performance in 2025, this year has also been characterized by strong spread performance for higher rated segments of the LevFin markets. US high yield spreads have traded in a very narrow and tight range despite all the macro and geopolitical volatility, while the broadly syndicated loan market has really widened out only modestly. Now, when we unpeel some of the layers here, the high yield and triple C and distressed market has a much less positive trend. Both cohorts there have posted total return losses on the year, and growing expectations for rate hikes have represented an inflection point in the trajectory of triple C and distressed spreads relative to higher rated segments, especially double Bs, which have really continued to march tighter this year. In the broadly syndicated loan market, the trend is even more extreme. Split Bs and triple Cs both trade over 1,000 basis point of discount margin and at deeply discounted prices. The macro environment, specifically the cost of capital, is exerting outsized pressure on key segments within the leveraged finance market, creating a cohort of perpetually stressed and distressed issuers that is far larger than what aggregate valuations would otherwise indicate. Now, across capital markets, the bite of higher borrowing costs and somewhat less market receptivity to many lower rated issuers is evident in recent primary market deal flow. I'll start with the good news. In the high yield market, triple Cs are currently on pace to match the highest level of deal share since 2022. That's 5.9% of total new issue activity. The less good news, especially for issuers, though maybe welcome for investors, is that these deals have come at a significant price in terms of a step up in borrowing costs. The weighted average coupon on triple C deals is 9.3% in 2026. That marks the highest level since 2023, when just 9 triple C rated deals hit the primary market. While liquidity is available for some lower rated issuers, they are oftentimes refinancing coupons with a 5 or 6 handle, as was the case with B&G Foods, which priced a discounted deal last week at an 11% coupon to refi a 5.25 2027 maturity. In the broadly syndicated loan market, primary trends underscore an even more difficult environment for lower rated loans, as the share of low B new issue volume has fallen to the lowest level of the past 10 years. While some of this is attributable to the repricing and extension bonanza of 2024 and 2025, The lack of lower rated activity highlights a less robust M&A and LBO environment than many envisioned heading into this year. With the BSL primary market shifting up in quality, weighted average new issue spread has fallen to just over 300 basis points, also marking the tightest level in 10 years, and highlighting the difficulty facing loan investors looking to add issuers with an attractive risk-reward profile to portfolios. This has really resulted in meaningful headwinds for CLO equity returns, as CLO managers are caught between robust demand for higher quality exposure to floating rate products. That's clear in year-to-date retail inflows, where CLOs are pretty much the only thing in positive territory on our left fin chart, and the reality of very tight weighted average spread levels for the more investable array of the broadly syndicated loan market. Amid a noisy macro and capital markets backdrop, default rates have held relatively steady since 2026, with U.S. high yield around 2.5% as of May 31st. Our colleagues at Fitch Ratings saw the broadly syndicated loan default rate a bit higher at 4.6% at the end of April. High-yield bond default trends in 2026 initially saw a slew of Chapter 11 filings, while distressed exchanges accounted for 3 out of 5 default events in May. In the broadly syndicated loan market, distressed exchanges have represented the bulk of default activity this year, with a smaller handful of Chapter 11 filings early in the year. And of course, I would be remiss if I didn't mention private credit on this webinar, as credit concerns remain front and center for this cohort. According to our colleagues on Fitch Ratings' private credit team, their measure of private credit defaults rose to 6% in April, as they recorded another 10 private credit defaults that month, as 7 of these issuers pursued stressed maturity extensions. Now, despite all the focus on software and tech and threats from AI, industrial and manufacturing issuers accounted for the bulk of defaults within the private credit portfolio, with business services only contributing to 2 defaults. And we observed similar trends in the high yield and broadly syndicated loan space. Perhaps even more notable within private credit, 6 of the defaults were from new, unique defaulters, but the other 4 were from serial defaulters, or those who have defaulted multiple times within a trailing 12-month period. And that's really indicative of the LME type environment that we're currently living in. As we look ahead to the remainder of 2026 and into 2027, we expect default rates to creep higher as broad-based relief from lower borrowing costs, without a corresponding widening in spreads, improved operating conditions, or a sudden surge in sponsor activity is becoming increasingly difficult to envision. While distress in the U.S. high-yield market is relatively low at around 6.7% of issuers, it has been remarkably sticky at that level since the Fed started raising rates, and is higher than it should theoretically be when we consider aggregate valuations. The broadly syndicated loan market is even more challenged, with almost 13% of issuers trading at loan prices below $80, and that includes over 30% of the telecom sector, which is admittedly a pretty small sector, and almost 25% of the technology sector, which alone represents 45 unique issuers. Ultimately, special situations come down to issuer-specific challenges, from operational headwinds to unwieldy capital structures. However, what I've described at the macro level has become a defining variable for stressed and distressed credit in a higher rates environment. Issuers unable to navigate the new cost of capital regime are increasingly finding their way into the special situations universe, bringing market participants a slew of liability management transactions and legal battles. With that, I'll turn it back to you, Mark.
Thank you, Winnie. That was very helpful to set the table at the macro level in terms of what's going on in the realm of special situations. I'd like to bring in Jory Eisenberg, our head of U.S. Special Situations, to talk about themes at the sector level. So, Jory, I'll turn it over to you.
Thanks, Mark. As mentioned, Jory Eisenberg, I head the U.S. Special Situations research effort. We have 5 analysts focused on the U.S. market, or North America more specifically, where we cover primarily stress and distressed credit. There are some other kind of bespoke situations here and there, but I'd say stress and distress is the primary bread and butter. I mapped out in a chart here just a little bit of just like how we view the special sits landscape. And like distressed credit is not really like a long-term home for companies. I mean, things either get better or they get worse, but the pathway to get there can be very convoluted. At the extreme, like you have a fully performing company, and at the other end of the spectrum, I mean, a company could be, go through a bankruptcy filing process. But the more prominent theme, especially over the last few years, has been in this middle road, this liability management, out of court restructuring land. And there's just almost unlimited creativity and scenarios and pathways within that, with the objective being to kind of give the company a new lifeline, whether it's pushing out debt maturities, lowering interest payments, or reducing leverage, or a combination thereof. The idea being to give the company a better position to, whether it's a cyclical business or not, to position itself to operate more effectively in that landscape. And there's a lot of press attention about LME kind of being a band-aid that is ineffective, and that definitely can be the case. I mean, you have multiple rounds of LME 2.0s or 3.0s, or LMEs that result in ultimate bankruptcy filings, and we have a handful of examples we've highlighted in this chart here. But it's not a foregone conclusion either, and we've highlighted a handful of examples in recent past of situations where that extra lifeline did prove to be effective, or at least initially appears to be effective, and lining these companies up with that extra breathing room has provided that much needed relief from the financial perspective. Highlighted here a handful of sectors that we think have been topically interesting. Not in any way trying to suggest these are the most important or the largest sectors or the exclusive sectors of stress and distress in the U.S., but we did want to spend a bit of time on each of these, as they've been a big focus area for our team and our fellow sector analysts, as well as our sister companies at Covenant Review and the news reporting business LFI. Building products is an area we spent a lot of time on this year in particular, partly because there's a large concentration of credits with very similar exposure and kind of a similar storyline there. We're focusing primarily in this case on the light side of the business, where these are companies that either manufacture or distribute products used in either the single-family, multifamily home construction, to a limited extent in commercial construction, as well as repair and remodeling. The macro theme is the common theme. High prices, which have not been helped by tariffs, high financing costs, as well as consumer confidence weakness, have all weighed on the demand side here, impacting it over the last couple of years, but also heavily impacting what our forward outlook looks like for the remainder of 26 and going into 2027. Offsetting that to a degree is historical aged housing stock, which suggests there's this massive pent-up demand for both necessary like R&R projects, if your roof is leaking, you clearly need to replace that, as well as more discretionary projects if people wanted to reboot their kitchens, their bathrooms, or other kind of major renovation that are more discretionary in nature. And so that was very relevant for one of our companies we cover, Cabinet Works, which is just wrapping up a liability management transaction currently. We highlighted a handful of additional names that we don't currently have under coverage. It's not a massive group, but most of these are privately owned, private equity owned businesses. Shifting to software, it's not a surprise to see that on the list here. AI disruption's been on focus for the entirety of 2026, with many of these credits trading down materially from the beginning of the year. We track currently, I think, about 50 plus software credits, almost all of which are private equity owned businesses that don't have publicly traded equity. But there is some differentiation across that space, notably on kind of like the vertical focus within a particular industry, or on the alternative, more horizontally focused businesses with product lines that appeal to a larger group of end markets. We've focused on a handful of names within one particular vertical slice, serving to the automotive sector, namely CDK and Solera, which are both private equity owned businesses, and we're going to talk a little bit about CDK in particular in a minute. Pivoting over to the combining the cable, TMT, and satellite all together. There's a lot of different storylines going in with that space, and it's not many of these aren't even new. The fiber versus cable debate continues on the geographic spectrum. There's a ground war game between entrenched incumbents versus overbuilders. I think in the wake of the recent or ongoing SpaceX IPO, this debate on the satellite side between LEO and GEO continues as well, as far as who's going to be the winners and losers, with SpaceX with a clear first mover advantage and infrastructure already in place to present a dominant position in there. Healthcare, there's some kind of fragmented situations that have, in many ways, dissimilar themes to them. Bausch, highlighted quickly, it's been a topical name for a couple of years, but it's largely an idiosyncratic storyline with a combination of a drug that's the predominant portion of its revenue and cash flow generation losing exclusivity in the near future that has a meaningful drop off in the company's cash flow potential, as well as some uncertainty around its holding in a publicly traded equity and what that distribution, if monetized, could look like for various stakeholders across the structure. Shifting to the hospital side, community health has been one name that our sector team has covered intensively. It's got a rural focus with the heavy, Medicaid payer orientation, and recent changes the regulatory side across Medicaid and Medicaid adjacent payment streams has been significantly impactful there. But trying to move quickly for the purpose of this webinar, I highlighted a couple of other sectors at the bottom that are also quite relevant. Don't have time to kind of go into them in any more depth today, but please do reach out to our team. Happy to kind of dig into many of the names we have under coverage or on our watch list that we are currently ramping on, as there's definitely no shortage of stress and distressed credits and themes going on at the moment. Next, I wanted to talk a little bit just about recent developments on both the LME side, kind of co-op formation, as well as kind of post-LME resolutions. Xerox, I think, has been probably one of the most notable situations within LME land. I think the traditional idea of the drop down, taking advantage of unrestricted subsidiaries or even to non-guarantor restricted subs, has been the pathway historically for a majority of these transactions, or at least the straightforward drop downs to take place. This kind of did away with that concept entirely, kind of playing into that white space of what is a subsidiary or what is not a subsidiary. In this case, kind of using a JV loophole effectively to move assets and put debt in a structurally senior position there. And even despite the fact that that transaction's already taken place, I think a lot of creditors are focused on various pathways where that same company could potentially do more or less a clone of the exact same transaction a second time, and what that might look like for remaining creditors. Optimum, not a name I personally covered, but I know it's been a very topical situation. I think Mark has also been involved in analyzing that, as well as our team from Covenant Review and sector teams. But it's been a multi-step process over a several-year period to try to effectively find ways to separate value between the core restricted group creditors and other stakeholders. The most recent movement, I think, was a particularly interesting one, inserting effectively a pref equity piece at an unsub level that kind of steps above what otherwise would have been the flow of value up to the common equity holders of that unsub box. So I think that's a particularly interesting one that is in early days of that current iteration. On the co-op side, I think I would say our team from LFI on the news side has covered extensively developments there. This is a software name that we've mentioned earlier, private equity owned business that has a co-op formed across many of its different creditor groups. And the interesting element there is just the tiering of economics being offered across different portions of that co-op. I think there's potentially as many as 4 different trading levels of whether you're like the core group within the co-op and the steering parties that get added to that mix, potentially other components of the co-op that are kind of like at a 3rd tier level, and then everybody else that's left behind in non-co-op land. And then lastly, I just want to talk about, I guess, in the wake of significant litigation that's happened in a couple of the companies we've covered, there's a very similar theme between 2 of these businesses, Telesat, which is in the satellite space, and Liberty Puerto Rico, which is a cable provider and otherwise infrastructure in Puerto Rico. Both completed LMEs within the last 12 months. And in both cases, creditors did file lawsuits, raising 2 primary claims, one on the fraudulent transfer side. The other is a covenant issue about what the ability to transfer what's defined as all or substantially all assets. Both those cases are in early days, but especially given they're tackling the same themes, we need to watch those quite closely and see how those play out. Highlighting at the bottom here, we're running a little short on time. Just a handful of credits that didn't really fit into any of the boxes that we otherwise talked through here. Hertz has been a pretty interesting one that went through a prior bankruptcy filing back in 2020, emerged as a solvent debtor. Many of the sector themes that put into trouble before still remain. It's a highly levered business that I think creditors are very focused on liquidity and its ability to kind of brave the period to, I guess, revert its EBITDA to like a positive, sustainable level. AMC, in contrast, has done 2 significant LMEs in a 2-year period, and then tried to raise new debt with substantially looser credit documents as more of like a regular way of refinancing and a simplification of the structure. That deal was not able to close. It's possible that does resurface at some point in the future, but our understanding is the market was generally not supportive to offer up substantially looser credit documents to a business with that kind of legacy history to it. But at the same time, the box office is performing quite well right now and is expected to end the year potentially in the best place it's been in a few years. So that remains an interesting one. And then Brightline's one our team initiated on just recently, kind of a unique structure, kind of combining both corporate and muni debt for a train system down in Florida. There's an interesting catalyst there that our team just wrote on within the next week, actually, as far as the remarketing of a portion of its structure. So we're quite focused on that one too. But that's me trying to summarize kind of everything we've been looking at in a tough 10-minute span. But I want to pass this over to my colleague from Covenant Review to continue the discussion.
Thanks, Jory, for setting the table. And my reaction here listening to you is that indeed there is a lot of activity in the special situations world. So a lot more to come, and I look forward to reading your research. So now let's turn it over to Ian Fang, who's a senior covenant analyst at Covenant Review, to give us a market update on liability management exercises or transactions and documentation issues. So Ian?
Thanks, Mark. My name's Ian Fang. I'm a covenant analyst at Covenant Review. We are a unique group of attorneys, all big law refugees who basically read credit agreements all day and yet somehow maintain our sanity over the years. I'll be talking primarily on a documentation front, but first we'll talk about trends and transactions with respect to liability management year to date. Now, there's been some chatter in the market that we're seeing less LMEs relative to prior years. And to some extent, that does bear out in the numbers that we're looking at. We are tracking 17 LMEs year to date. That's compared to 25 and 19 such transactions over the same period in 2025 and 2024, respectively. Now, market observers have suggested that this decrease is maybe more significant than I think is I think it's less. Excuse me. A lot of market participants think that the LME decline is due to lender resistance. I think the numbers don't really bear that out just yet. This is due to the perennial issue of LMEs, which is categorization of an LME is often more art than science, which suggests that these numbers are somewhat movable. Further, the underlying drivers of LME activity, I don't think have really changed over the course of the last few quarters. We're talking about extreme covenant flexibility, CLO activity. Because those haven't really changed, there really isn't a reason for LMEs to kind of decrease in prevalence. So my guess is really that the types of LMEs are changing. We're seeing less of those traditional drop downs, up tiers, and more complex multi-step transactions, or transactions that kind of take advantage of more bespoke structuring elements, things like pref equity or holdco PIK debt or things, or coercive amend to extend. Those kinds of more unique or bespoke structures are becoming a little bit more popular. On a post-LME front, Covenant Review and LFI are tracking 5 bankruptcies from companies that previously conducted LMEs year to date. That's Cumulus, Pretium, Packaging, Saks, STG Logistics, and most recently Trinseo. Now, you could probably lump in United Site Services in there too. That filed shortly before year end. One key trend to keep an eye out on for 2026 and beyond will be alternative to Chapter 11. I think Jory's first slide was very helpful in kind of setting the table in terms of, well, once you've done an LME, what do you do next? Yes, in some cases, the company does get better, although for many of these companies, the LME merely extends the runway. It doesn't really fix the underlying problem. So you expect to see more Chapter 11s down the road. But at the same time, we are seeing alternatives, things like European processes, especially the UK scheme of arrangement. We're seeing some US companies take advantage of that, Fossil and New Fortress Energy. And second, LMEs are definitely in the mix, as are equitizations, particularly as so-called stock-in-the-box provisions are being designed to hand the keys over to creditors if a company fails to meet certain milestones after their initial LME. I'm not going to spend a ton of time on notable transactions in 2026. I think Jory picked up a lot of them. I think Xerox, of course, is the big one that happened in 2026. And just because it's the poster child of the continuing evolution of the LME playbook. Yeah, we're still getting those drop downs and up tiers, but there's always a variation on a theme now. Often you're going to see complex multi-step transactions instead. Cabinetworks and Vibrance are good examples of that. And as previously mentioned, we are seeing more of those bespoke A to E's and other unusual structuring as well. Now, in terms of how the documents look from sort of a macro level, Covenant Review does score our covenants that we review. And we score it from 1 to 5, 1 being very conservative, 5 being more aggressive or loose or providing more flexibility for the company. And for the most part, the covenant scores are either declining or stagnant. So don't get confused by the chart that's on this particular slide. I'll explain why. For the most part, the covenants tend to get more aggressive over time, and that's borne out over the course of the last few years. That slight uptick you see in the chart, and this is a chart showing the 3-month rolling average of covenant scores on both PE-backed and the broader market. That increase, which is to say the more conservative scores kind of taking hold in the last few quarters, that's more driven by some specific transactions. A number of conservative energy deals that came through in April is dragging the scores to the more conservative end of the spectrum. I expect the scores to kind of go back to being a little bit more aggressive once those deals start to roll off those 3-month averages. If we look at just PE-backed loans, you can see, of course, more aggressiveness. So it's a 3.89 versus a 3.63. The higher the score, the more aggressive, the more flexible it is for the borrower. Now, one big theme we had in 2025 was anti-co-op, anti-law firm language. I certainly harped on this. I said, this is the attack on the process control within the documents, trying to prevent lenders from forming cooperation agreements or hiring certain law firms. And my guess at the end of 2025 was that we would see a lot more of these in 2026. And that really hasn't come to pass so far anyway. 2026 has really been more of a retreat for both of those kinds of provisions. No anti-co-op language has cleared the BSL or high yield market. There's been one outlier in the PC market. That was the Majesco deal that had a kind of anti-co-op language. It was a little bit softer than what we had been previously seeing in that it only required the reporting of the formation of a co-op. Anti-law firm language, meanwhile, pretty much DOA at this point. It is not being pushed in the market, I think, because it was pretty aggressively rejected when we started hearing about it last year. There are a couple of softened versions of it that try to limit indemnification or expense reimbursements for certain law firms, but that kind of more egregious, you are not allowed to hire XYZ law firm, that really isn't in the market at the moment. Lender protections in general are primarily stagnant at this point in time. Through 2026, we're seeing lenders and syndicate members really pushing for the same trifecta of protections when it comes to LMEs, and that's J-Crew blockers, Chewy blockers, and CERTA blockers. And really with very limited exploration of other kinds of LME protections, so things that block double dips, i.e. at-home blockers, vote rigging blockers, i.e. Encora blockers, omnibus blockers. Those do appear on rare occasions, but for the most part, they are absent in the new issue market. Now, for Xerox, Xerox blockers was thought to be maybe something that would start coming into view post Xerox. As Jory mentioned, this was a drop down to a JV as opposed to an unsub. So there was some expectation that lenders might start to push for that kind of blocker where you can't move assets to a JV or something of the like. We did a report a few weeks ago, which you can access through the webinar resources, but essentially we're not really seeing that happen. Lenders, for the most part, are not pushing for so-called Xerox blockers. And I think that makes sense in that there's a limited amount of things that lenders can do when they're faced with a 24-hour deadline or shorter when they're looking at a credit agreement or indenture. They're going to ask for that main trifecta, the J. Crew Chewy Serta language, but they're not really going to push much further. And I really don't expect that to change in the near term. And I'll pass it back to you, Mark.
Ian, thank you very much for giving us the update on documentation and LME issues. We're going to move into our final segment for today's webinar, which is legal and restructuring developments. I'm going to take a look at some important litigations that I think the market wants to know about, and in many cases does, and then I'm going to pass it over to my colleague, Pat, at Levfin Insights to talk about developments in bankruptcy. So the first slide here is a slide called SCOTUS Watch 3 Key Cases. And I should note up front, or joke perhaps, that most bankruptcy and restructuring professionals don't get to play in the SCOTUS arena very often. But there's enough interesting docket activity touching the credit markets and bankruptcy and restructuring that it's worth spending just a couple of minutes talking about it. So let's start with 3 cases that we're watching at the Supreme Court. The first case is a case called Monsanto v. Durnell, and it's a highly relevant case in the special situations world because Monsanto's parent company, Bayer, has over $40 billion in funded debt that is widely held by IG investors in the United States and in Europe. And many of you probably have seen this, but Monsanto has been embroiled in litigation over the use of its glyphosate in the popular weed killer Roundup. And it's literally faced tens of thousands of claims, mostly for failure to warn. And those claims basically are that Monsanto failed to warn consumers that Roundup and the active ingredient in Roundup, glyphosate, can cause cancer. And the situation has put significant pressure on Monsanto and Bayer, and restructuring professionals have been following it closely because it has many of the hallmarks of companies driven towards bankruptcy by overwhelming litigation claims. And the legal issue that the Supreme Court is going to decide is whether the Federal Insecticide, Fungicide, and Rodenticide Act, also known as FIFRA, preempts those state law failure to warn claims that I mentioned, where the Environmental Protection Agency has approved labels on those products without a cancer warning. Now, a win will be materially beneficial for Bayer's Roundup exposure. It could bolster its credit, and it could stand, frankly, as a notable example of managing mass tort liabilities outside the Chapter 11 process. The Supreme Court heard oral arguments on April 27th of this year, and the United States government, acting through the Solicitor General, supported Monsanto. We expect a decision from the court by the end of this month. The court issued decisions right at the beginning of this webinar and did not issue a decision on this case, so we expect a decision on that case by the end of the month. If Bayer were to lose, we think, and by the way, our working premise is that Bayer is more likely to win than not, but if they were to lose, it may push Bayer into more aggressive settlement activity, and it raises a real restructuring risk. So keep an eye out on this case by the end of the month. The second case that we've been following is a case called Official Committee versus Bestwall. And actually, the Supreme Court did not take this case, but we think the fact that it did not take this case is just as important, and I'll tell you why. It's somewhat of an overlooked case by investors because it does not involve funded debt, but it was the first, or certainly one of the first cases that implemented what is now well known in the financial and restructuring community as the Texas two-step divisional merger strategy. And just a quick background about that case. Georgia Pacific, which is a subsidiary of Koch Industries, used a divisional merger to isolate its asbestos liabilities in a company known as Bestwall. And this was known as the bad company because it had all the liabilities and none of the assets. And it took all of the assets of Georgia Pacific and put it into a new entity called New Georgia Pacific. Now, the company bankrupted Bestwall and kept New Georgia Pacific out of bankruptcy and was able to obtain an injunction from the bankruptcy court protecting New Bestwall, which had all the assets from any litigation claims. And so naturally, this raised all kinds of complicated bankruptcy issues. And a lot of other companies tried to follow on with the strategy. Notably, Johnson & Johnson, with all of its talc liabilities, tried to bankrupt one of its subsidiaries 3 different times and failed each time. 3M did the same thing. They tried to isolate certain liabilities related to earplugs that they manufactured, and they failed in that endeavor. But the Bestwall case is, in fact, alive and well. It has not left bankruptcy. It's been in bankruptcy for over 8 years at this point. Not a single penny has been paid to creditors. And so this case raised a whole bunch of really important legal issues for the restructuring community, including whether a solvent debtor with a conceded ability to satisfy its liabilities can even invoke Chapter 11. What is the standard for a bad faith bankruptcy filing, and whether bankruptcy courts even have subject matter jurisdiction over solvent debtors. All of those issues were presented to the Supreme Court, and the Supreme Court denied cert last month on that case, on May 1st. So the Supreme Court is not taking that case. But the bottom line is that the Texas two-step remains legally unsettled. It has not yet succeeded as a durable bankruptcy strategy, and although the Supreme Court has so far left several key questions unresolved at the highest level, we think courts are ultimately likely to not endorse it at the end. And finally, the last case at the Supreme Court that I wanted to highlight is Highland Capital Management. At this point, many restructuring professionals, most restructuring professionals are familiar with the Purdue Pharma case that the Supreme Court decided a couple of years ago, which held that the Bankruptcy Code does not authorize non-consensual third-party releases. Now, for those of you that read the decision, you'll note that in dissent, Justice Kavanaugh warned that the majority's reasoning could cast doubt on other very important bankruptcy tools, including exculpation clauses, which protect parties that actively participate in the Chapter 11 process from certain forms of liability. So the issue here is the permissible scope of exculpation provisions and gatekeeping injunctions to protect non-debtors who participate in a Chapter 11 plan. And the Fifth Circuit, which is the lower federal court that addressed this issue, took a very narrow view of what bankruptcy courts can do in terms of granting exculpation relief. On May 22nd of this year, the Solicitor General, again representing the United States, urged that the Supreme Court not take the case and argued that the issues should continue to percolate in the lower federal courts as a result of the Purdue Pharma decision. So that petition for certiorari has been set for conference on June 25th. So it's very possible that we'll have a decision on whether or not the Supreme Court will take that case by the end of June. So just as you can imagine, June is a very hot month for the Supreme Court, and we're going to have a lot of really interesting activity coming out of the court in the next few weeks. So stay tuned for that. Finally, I'd like to spend a couple minutes before handing it over to Pat to give the folks an update on cooperation agreements in antitrust law. Earlier this year, we hosted a webinar with the Creditor Rights Coalition and our friends at Cleary Gottlieb on the intersection of cooperation agreements, which we often, as folks here have referred to as co-ops, in antitrust law. The panel focused on 2 cases pending in the Southern District of New York that challenge cooperation agreements on antitrust grounds, primarily under price fixing and group boycott theories. These lawsuits are important to the markets because co-ops are an important mechanism for creditor coordination in the pre-bankruptcy context and are commonly used to protect collective rights in distress situations. Any judicial guidance on the extent to which these are permissible or impermissible could have lasting implications for debt restructurings and workout negotiations. Now, the 2 lawsuits are Optimum, and in that case, the company itself, under the direction of Patrick Drahi, sued a co-op representing 99% of the creditors of its $26 billion debt stack. The second case is Selecta, and in that case, an excluded group of minority lenders sued the majority lenders because they could not participate in the restructuring. So we've got these 2 different cases, Optimum on the one hand, which is borrower versus creditor, and Selecta on the other hand, which is minority group of creditors versus majority group of creditors. But they raise the same legal question, which is the lawfulness of collective action in the pre-bankruptcy world and whether that actions violate the antitrust laws. So in terms of posture, both of those cases have pending motions to dismiss. There has been no oral argument on that. And so we don't have any kind of judicial guidance as to what the permissible guardrails on cooperation agreements are at this point. So stay tuned. It's going to be very interesting. I should note that just last week, Optimum engaged in a very clever and unique transaction that effectively transferred value from its equity holders to certain other parts of the capital structure to get ahead of the restricted group under the auspices of trying to foster negotiation. So it's very possible that the Optimum situation may resolve itself consensually through an LME or otherwise, such that we may never receive a judicial outcome on that litigation. So with that update, I'm going to hand it over to Pat, who's going to talk about bankruptcy developments.
Thanks, Mark. Hi, everybody. I'm Pat Holohan, managing editor of the bankruptcy team here at Lefin Insights. I want to start with a look at what's happened so far in Chapter 11 in 2026. We've had more than 30 filings this year that had at least $100 million in funded debt. That chart you see on the right side of the screen is from LFI's bankruptcy database workbook, which catalogs all of these cases with detailed information on pre-petition capital structures, exit capital structures, counsel and advisors, creditor holdings, and creditor recoveries. Our biggest cases so far this year have been QVC Group, Multicolor, and Trinseo by debt load, at least for Chapter 11. We've also seen a few large foreign debtors using Chapter 15 to get recognition of their restructurings in the U.S., including Raisin and NFE Global. The Southern District of Texas remains by far the most popular bankruptcy venue, and I'm going to be talking about several Texas cases shortly. So when we talk about bankruptcy, we often discuss a debtor or a soon-to-be debtor, who they've gotten on board with the restructuring plan. A company hopes to sign a restructuring support agreement, or RSA, with one or more ad hoc creditor groups. Generally, it's what makes a successful bankruptcy case. The power of those creditors to successfully negotiate a restructuring with a debtor that sets the tone and structure of the case is well known. But what about the power of someone or a few someones looking at that result and yelling, no? Enter Castle Knight Management, who has been that someone so far in the first half of 2026. The New York-based hedge fund, founded in 2020 by Aaron Whiteman, nephew of Appaloosa's David Tepper, popped up in the last days of 2025 in the case of United Site Services, a provider of portable toilets. United Site entered that case with an RSA, but Castle Knight objected to the DIP financing, announcing its intention to undo a 2024 double DIP transaction. A double DIP is a transaction where a creditor gets two unique claims, secured claims in a capital structure, giving it twice the collateral coverage. But there would be no climactic battle and no digging into the double dip, at least publicly, as the parties settled, with Castle Knight agreeing to become a commitment party under a rights offering with the same rights as the RSA creditors. Next, we move on to the Lycra Company, a maker of textile brands worn by gym goers. It launched its case in March in Texas with substantial creditor support, but was quickly met with opposition from Castle Knight, which teamed with Burlington Loan Management to oppose the company's Chapter 11 plan. The pair argued that the majority ad hoc groups supporting the plan through the RSA had scooped up all of the company's value through the deal at the expense of creditors not in the ad hoc group. But before we could get a judicial reckoning, the debtor settled with Castle Knight, reaching a deal that allowed the minority group to purchase a minority position in the exit debt and avoiding a planned confirmation fight. Last month, Trinseo, a plastics and latex manufacturer, launched its own Chapter 11 case in, where else? Texas, with an RSA. But an ad hoc group led by, again, who else? Castle Knight, is accusing the debtor and other lenders of violating the parties' credit agreement through a 2023 liability management transaction with, again, a double dip that disadvantaged certain lenders in favor of others. Now, I should note in this case, Castle Knight was originally a member of the RSA group, but backed out ahead of the bankruptcy filing. While Castle Knight was able to lock down settlements in the first two cases, Trinzio is still in the early stages of its case. And I think we've gotten some real color here on debtor and other creditor thoughts on Castle Knight's third entry into the fray here in the first 5.5 months. At the first day hearing earlier this month, debtor counsel called Castle Knight's account of the LMT a, quote, fictional narrative. Counsel noted that the hedge fund bought up its debt after the LMT and accuses Castle Knight of pursuing an investment strategy of buying up out of the money debt in Chapter 11 cases to fight highly supported plans, quote, not really relying on the merits, but on the back of the cost to the estate. Now, before this first day hearing could really break out into a fight, Judge Christopher Lopez cut it off, saying, quote, there will be a fight and everybody can tell me what everybody's doing. So that day of reckoning is still to come. The next month or so will reveal whether Castle Knight can keep getting paid to go away or whether we're finally going to get a confirmation trial in one of these Castle Knight cases. Now, I want to move over into releases. Mark talked about this a little before. To very briefly recap, in 2024, the U.S. Supreme Court finds that non-consensual third-party releases are not permitted in Chapter 11. Creditors cannot be forced to release these claims. The fallout from that decision is something that we've covered extensively, as debtors and the U.S. trustee program go back and forth on what constitutes consent in a Chapter 11 context. Debtors argue that parties should be deemed to have accepted releases only if they opt out of releases affirmatively, while the U.S. trustee argues that that creditors should only be deemed to have granted a release if they opt in. This opt-out, opt-in dynamic is something we've seen play out all across the country. This is one of those things that we could talk about for a long time, but I want to focus on a specific case. Here, the Container Store, another Southern District of Texas case, where the debtor and the U.S. trustee had the opt-in, opt-out debate. The bankruptcy court ruled in favor of the debtor, in favor of opt-outs, which is the norm in the Southern District of Texas, and more broadly, the norm in the Fifth Circuit. But the U.S. trustee took that matter up to the district court, which largely upheld the bankruptcy court's decision, finding that opt-out provisions were appropriate, except for two creditor classes that the district court judge determined did not receive adequate notice. Now, both the debtor and the U.S. trustee are trying to bring that matter to the Fifth Circuit in a cross appeal, given it was a split decision, but largely in favor of the debtor. There hasn't been any action in that appeal so far. Briefs for both sides are due on June 22nd. Now, while Purdue focused explicitly on Chapter 11, the issue of non-consensual releases came up recently in the Chapter 15 case of Mexican consumer financing company Crédito Real. In that case, the bankruptcy court granted U.S. recognition of a Mexican restructuring plan that featured non-consensual third-party releases. The U.S. International Development Finance Court appealed that decision, recognizing the plan with non-consensual releases, but a New York District Court judge found in March that the bankruptcy court, quote, did not err in declining to apply the Purdue standard to a Chapter 15 case, emphasizing that Purdue is specific to Chapter 11 and that U.S. courts have authority to permit enforcement of foreign court orders that contain non-consensual third-party releases. IDFC appealed that decision to the Third Circuit, where it remains pending. So we will see how Purdue intersects with this or not. It's something that we will be covering everything that happens over the next few months or a year plus. Finally, I want to look at a couple of 2025 cases that have been very active so far in this first half of 2026. I'll start with the name that I assume everyone on the call knows. First Brands, probably the biggest Chapter 11 filing of 2025, has been, to sum it up briefly, working to wind down its operations and sell off its assets over the past few months. In April, the debtor filed a plan centered on a settlement with an ad hoc group of lenders and the Unsecured Creditors Committee that would have transferred the estate's assets to an affiliate, Premier Marketing Group, which would then have established a liquidation trust, have the DIP lenders credit bid the estate claims, including avoidance and recovery actions, government forfeiture proceeds, and more. All debtors other than Premier Marketing Group would have had their cases converted to Chapter 7. However, the U.S. trustee comes in and says they want to dismiss the main case or convert it to Chapter 7, alleging that the company is administratively insolvent and has no ability to confirm a plan. The U.S. trustee argued that the settlement would have transferred away the company's most valuable assets to the affiliate without any consideration return, leaving the company unable to pay more than $200 million in administrative claims, even as the debtor aimed to pay more than $200 million in professional fees. The government watchdog argued that a Chapter 7 trustee could liquidate the debtor's remaining assets and pursue litigation claims at just a fraction of the cost that the original plan would set up. The company took another hit when Judge Lopez denied conditional approval of the disclosure statement, finding that the debtor had not provided enough time for creditors to review it. First Brands amended the plan last week, pivoting away from the funneling of assets to the affiliate and the Chapter 7 conversions, instead now intending to set up a litigation trust at the main debtor that would pursue recoveries on behalf of creditors without a conversion. A hearing on the disclosure statement for that amended plan is scheduled for tomorrow. Those watching live, those not, it's June 12th. So this is something that's going to extend well into the second half of 2026 as well. Finally, the last case I want to hit on is Del Monte Foods, which is a subsidiary of packaged foods giant Del Monte Pacific. The company filed for Chapter 11 just under a year ago, went on to sell its assets and confirm a plan of liquidation centered on a global settlement. Sounds pretty simple, basic, but it's not, because along the way, a minority term loan lender group sued the debtor, arguing that the company's DIP financing breached the parties' credit agreement by violating a sharing provision. Now, the DIP rolled up about $250 million of the approximately $400 million outstanding in first out term loan debt, reducing the pre-petition debt owed to the majority group, but providing no participation interests, no compensation, and no other consideration to the minority group. The minority ad hoc group requested a declaratory judgment that the terms of the super senior facility are binding on the parties, that the rights under the sharing provision are sacred rights, and that they can't be altered without the express consent of each lender. The group also objected to approval of the global settlement and plan confirmation, arguing that they were unfairly discriminated against under the plan. Now, the minority group lost every single fight it started in bankruptcy, but the battle will continue. The group has appealed the decision and asked the bankruptcy court to allow it to bypass the district court and take the appeal directly up to the Third Circuit. So we will be reporting on that in the next few weeks. Either way, if it stays at the district court or goes up to the Third Circuit, in our regular LFI bankruptcy coverage. And that's it for me, Mark.
Awesome. Thank you, Pat. We're at the top of the hour, so this concludes our webinar. I want to thank Pat, Ian, Jory, and Winnie for joining us today. Again, if you have any questions, please feel free to reach out to any one of us through this webinar or connect with us on LinkedIn, and we're more than happy to make the slide deck available to anyone who asks. Have a wonderful day, everyone. Thanks so much.